Right now, the world is watching tensions between Iran, the United States, and Israel. But while the headlines focus on geopolitics, financial markets are reacting instantly. Gold is rising. Oil is surging. Stock markets are turning volatile. And for traders, this creates a powerful dynamic known as the war trade. In this video, we're going to break down exactly how wars impact financial markets and how traders analyze gold, oil, and stocks during global conflicts. Section 1. Why war moves markets. Financial markets hate uncertainty. War creates uncertainty in three major ways. First, economic disruption. Supply chains break down, energy prices surge, inflation rises. Second, investor fear. When global risk increases, investors move money into safe assets. Third, energy supply risk. The Middle East is one of the most important oil-producing regions in the world, and when conflict threatens supply routes, oil prices react immediately. Section 2. Why gold spikes during war. Gold has been considered a safe haven asset for centuries. When global risk increases, investors often move capital into gold. This happens for three main reasons. Gold protects against inflation. Gold is not tied to any single country's economy. And gold historically performs well during geopolitical instability. So when global conflicts escalate, gold often experiences strong demand. Section 3. Oil, the most sensitive war market. Oil markets react faster than almost any other asset. Why? Because oil supply is heavily concentrated in politically sensitive regions. One of the most important locations in the world is the Strait of Hormuz. This narrow waterway carries around 20% of the world's oil supply. If conflict disrupts that route, oil prices can spike dramatically. This is why traders watch oil closely whenever Middle East tensions escalate. Section 4. Stocks, winners and losers. War doesn't affect stocks equally. Some sectors tend to struggle. Airlines, travel companies, consumer spending sectors. But other sectors often benefit. Energy companies, defense contractors, commodity producers. Understanding this rotation helps traders identify opportunities. Section 5. How traders analyze war events. Professional traders don't trade emotions. They analyze volatility, supply disruptions, investor sentiment. Instead of reacting to headlines, they watch how markets respond, because sometimes the biggest moves happen after the news is released. Section 6. Risk warning. Trading during geopolitical events can create huge volatility. While opportunity exists, risk also increases dramatically. That's why professional traders focus on risk management. They plan trades carefully and avoid emotional decisions. Global conflicts reshape financial markets. Gold becomes a safe haven. Oil reacts to supply risk. Stocks rotate between winners and losers. Understanding these relationships helps traders navigate volatile markets. If you want more insights about trading, global markets, and financial psychology, subscribe to the channel because the markets move with the world, and the more you understand the world, the better you understand the markets.